Welcome back to the Moneyweb Better Investor Conference. I've hoped you enjoyed the sessions throughout the day. We've had various sessions on investing, and now we move into our personal finance section. And for this section, some of the questions that we answer have been questions that have been quite hot topics on our social media pages. One such topic is one that we're about to dig into now. I'm joined by Elke Brink from PSG Route 21. She's a director at PSG, but what you might not know is she is the youngest qualified CFP. She qualified as a certified financial planner at the age of 22. Not many people can say that they've achieved that. And she's joining me to chat about the big question around retirement. And the question that we've posed is, can you retire on 2 million rand? Now, 2 million rand seems like a lot of money for some people that haven't seen that sort of money in life. Most of us haven't seen that sort of money in life. It seems like something you can retire on. But having had this conversation off air with Elke, I can tell you the answer is most likely going to be no. But let's dig into that and let's see how that conversation unfolds. Thank you so much for joining me, Elke.
Thank you for having me. It's good to be here.
I guess let's start with that question. So, yes. Can you realistically retire on 2 million rand?
I think when it comes to retirement, you need to define what you need to earn per month. And I think there the answer is going to be different for each individual. But really understanding what the value of money is. So if you were to reach retirement today, I think firstly realizing, let's say the average age people retire is 65. These funds need to last for potentially another 25, 35 years. So we need to make it last. So a few things become very important when it comes to how you manage this time frame in your investment strategy, is how it's invested. How do we make the capital last as long as possible? And ultimately, it comes down to what do you draw down from this investment without depleting the capital so quickly. So I think to give a rough answer on what the fundamental here is we normally advise not drawing more than 5% of fund value if you follow a specific investment strategy. So that would come down to just over 4,000 rand per million rand you have to work with. So I think when you backtrack from there is what do you really need per month and how do we get to that stage? So if we work on a 2 million rand investment, you're going to be able to earn just over 8,000 rands basically a month if we want to make sure the funds don't deplete.
So, I mean, we'll get into a lot of the things around depletion and how that's set up. But the crux of the matter is the planning stage of it becomes very important. And planning to ensure that at the point where you get to the retirement age, you have enough to sustain you beyond that so that you're not dependent on the social grants of the state and those sorts of things. Looking at that planning phase, where does that start? Do you start planning just before you retire? Do you start planning when you get your first job? Where's the best time to start that process?
I think when it comes to building any resilient investment portfolio, the main gift you can give yourself is time. And it takes a lot of pressure off later on in life. I think a lot of the negativity around financial planning comes when the pressure starts loading and we, from a financial point of view, start saying, okay, now you need to save 50% of your income, which is completely ridiculous. So I would say the moment you start earning an income, just starting to really benefit from time in the market and that effect of compound interest, and you'll take a lot of pressure off later in life. So I think there's a principal idea out there in the world that you need to save 15% of your income and you will be okay for retirement. But this percentage doesn't really apply if you only start off, for example, if you're 40 or 50 years old. So 15% is a calculation that applies when you're 25 years old and you just started working. So I think that's quite important to know exactly what do you need to save for your specific scenario and starting off as early as possible and just getting used to it. And you will have 40 or 50 year term to actually invest for.
So how do we save? Save where? Do we put it under a mattress? Do we, because I mean, I've started a job. I now earn 8,000 rand a month. I've got the ability to save 500 rand a month. Should I be putting it in a fixed deposit? Should I go straight for an RA? Where does that process start? Because a lot of the time when we get our first jobs, there's the pressure to get a vehicle, to get a property to stay at, to rent a place, or to, buy certain things. And I think the saving component that you mentioned is probably the most important one at that stage. But where do we put that money so that we don't have to be focusing on it?
Yes, I think ultimately you want to start building up the ideal portfolio, which would consist out of a few different things once you start working. And it's not possible everything at once. You have a lot of expenses, a lot of pressure, only earning X amount once you start working. But I would recommend starting off at least once you start earning an income to optimize your tax benefits. So maybe start off with retirement annuities, start off with your company pension or provident fund if they offer that benefit, and at least having that additional tax benefit as well, where you can start optimizing that from the start. And as you start growing into your portfolio, we start adding on different products that have different tax benefits. So a tax-free investment, an emergency fund, a different type of vehicles that would have various investment strategies and different tax benefits in your portfolio. So they all play a different role. You would have shorter term planning, longer term planning, but I think the main crux of it would be to be invested in growth assets, especially as a younger person, and that would mean equity exposure. So not just being too conservative, because it doesn't really help if you're just saving in the bank and you're basically earning, you're just keeping up with inflation, if even. So just having that benefit of earning above inflation returns over an extended period of time, and then you'll be fine. And I think what goes together with this planning is, and that would define what you actually need at retirement, is if you can also become or plan to be in a situation where you don't have debt. I think in principle, the end result needs to be planned for. So what is your expectation in terms of expenses per month, income per month, and then we can start planning around that. You can very much comfortably retire with 2 million if you don't have a lot of additional expenses. But if you're in a situation where you still have a lot of commitments, liabilities at that stage in life, then it becomes a difficult story.
I like that you touched on the debt thing because, I mean, one of the questions is obviously, at the point where you're about to retire, let's say you have managed to pay off your debt, how significant a difference or how significant an impact does that make on your ability to retire comfortably, given the fact that what we all know is even at retirement, your funds are still taxed?
Yes.
So how big a difference does it make if you go into that situation having paid off as much of your debt, and is it worthwhile to keep some debt to go into retirement with?
I think that's quite an interesting question, because I think a lot of younger people also, if you have a mortgage or a bond or a study loan or whatever form of debt you're paying off, I find that a lot of people only want to focus on that. So they don't end up saving in their investment portfolios. So for 10 or 15 years, they're just focusing on paying off this component in their portfolios, where you're losing a lot of time in an investment portfolio, and exactly the benefit that I'm explaining now, of the benefit of compound interest. So in the perfect world, you would want to be in a situation where you have a significant, which is relative, portfolio built up, which you can live off from, and not having additional expenses that you still need to. You basically, the largest headache at retirement is your medical aid, which becomes extremely expensive, and it's normally almost a third of your income that you just spend on keeping your medical aid in place in a phase in life when you really need it. But I think if you can manage a type of portfolio where you don't have a bond you're paying off, especially with interest rate cycles that can move around all the time like we're seeing at the moment, and then together with that, yes, keeping in mind, depending on what the source of funds are, your income that you're going to start drawing from your investment portfolio is still taxed at an income tax level. So you need to plan for that additionally. So being able to accommodate that tax income and still having enough net income to be able to live off.
To survive off of, yeah. I want to look at something that you and I spoke about off air around the structure and the strategy that you use to then employ to ensure that you optimize your retirement plan. Particularly, I mean, we spoke about things around replacement ratios and very technical terms when it comes to retirement. But I mean, can you just shed some light on the strategy that you should employ, considering things like that, like the replacement ratios and all of that, to ensure that at the point that you retire, you've saved up enough, you're spending the minimal amount. Where's the sweet spot in terms of what you can draw on and that sort of thing?
Yeah. So I think there's two parts to it. I think leading up to retirement, what I just referred to about the 15% assumption, I think a lot of investors make. I think firstly, really approaching it on an individual level. So knowing that a 22-year-old and a 30-year-old or a 40-year-old are going to save different percentages, depending what you have already saved, how it's invested, what is the return you're earning on your investment. That's going to depend what are you supposed to be saving to be able to replace. And if I can maybe just elaborate on replacement ratio, the average investor normally retires with around 75% in the ideal world of their last income. So it's very rarely that you actually retire with exactly the same income level you were used to. but with the assumption that your expenses would hopefully be less. Of course, in the ideal world, you want to keep your standard of living and what you're used to doing, but then you need to be sure you are actually saving enough from the start. So firstly, I would approach that on an individual level. Either calculate it yourself, where there are significant tools that can help you with that, or approach an advisor that can assist you to ensure that you are contribution-wise saving enough. It doesn't help your portfolio is earning an excellent return, but you're physically not saving enough compared to what you're earning. And then together with that, when it comes to how the retirement is managed, and I think that's extremely important when it comes to the strategy, is to not be invested too conservatively. You still need to ensure this capital is going to last for X amount of years, which is life expectancy would be at least 30 years plus. So building a strategy that in the short term you are protected against significant market volatility, where your income is drawn from, where we normally use cash and bonds. And then together with that, all the capital you will mainly only need, let's say 4 or 5 years onwards, we build in growth assets. So ensuring that you are earning an above inflation return on this portfolio. So basically 2 things need to happen at retirement, or 3 things. You need to outperform inflation, and you need to outperform your income drawing to be sure that you can, I don't know how long you're going to live for. So you might live to be 110, and we need to ensure the funds aren't going to run out. So the strategy becomes extremely important. I think there's automatically a conservatism that kicks in once you reach retirement, that you don't want to take risks with your funds because you're not going to be bringing in more capital. But that's almost more of a risk. So I see just being invested in cash almost more risky than having exposure to equity exposure, because basically inflation is going to deplete your capital within years.
You mentioned something about short-term investing, and I like that you did that, because we've got a question from Sonia saying, is it possible to have a short-term investment strategy of 5 years considering the current global instability?
Definitely. I think it depends how it is invested. Maybe this SVB was a very good example of how to invest short-term funds or how not to invest short-term funds. Different asset classes play a different role in your planning, and I think anything... I would say 1 to 2 years' time, you can basically do cash exposure. Anything over and above that, you start building in bond exposure. But with bond exposure, for example, you need an 18-month rolling period. So something that is seen, and I think it's a very big lesson a lot of people learned in the last 2 weeks again, as a safe haven asset, can be very volatile, and it can react differently than planned. So yes, short-term exposure needs to be invested quite conservatively, and there would be different pockets built into that. 5 years is actually a long time still. You can start building in slightly more risk when it comes to that period of time. But I think what you always want to achieve with any portfolio is just keeping your options open. Should you move through a market cycle where either bond exposure or equity exposure reacts in a way that you don't want to sell off at that stage, and you can wait out the cycle. So just ensuring there's enough liquid assets as well where you won't be negatively impacted.
Let's look at that liquidity component, right? How different, or how many different investment vehicles should one have to retire comfortably? So earlier in our conversations, we looked at things around alternative streams of income and that sort of thing, just to balance out against what you're drawing down against. But from a retirement point of view, the investment vehicles that you have, things like an emergency fund or things like a side fund that you contribute towards that is beyond, or second RA, for example, those different types of vehicles, how would they contribute towards your retirement? Again, looking at the fact that your retirement funds are still going to be taxed and those sorts of things. Is it wise to have more than one RA and that sort of thing? If they're all going to be taxed, are they taxed at the same rates? And how does that work?
I think combining a few different products, because you can optimize your tax implication at retirement also by combining different products. So I wouldn't necessarily advise having everything just built up in a retirement annuity or a pension fund, for example. Especially for people who are only starting out to build their portfolios now, a tax-free investment, for example, can be optimized in a great way, almost as a retirement structure as well, which we haven't really seen play out because it's still too young. But if you had to build up a significant tax-free portfolio, and you can start drawing an income from this portfolio where you're not going to pay a cent tax on it, together with that, you'll have your retirement annuity, possibly also a retirement fund that comes from your employer, should they offer one. I wouldn't necessarily recommend having more than one retirement annuity, but you can diversify within the investment by optimizing different managers, different styles within the structure, and that way keeping fees at a low level, but also diversifying your strategy. And then lastly, which I think is very important at retirement, and the tax-free can play a role here, but having a normal, accessible investment, because I think apart from the tax implication with the retirement annuity that is taxed at an income tax level, it's also tied up quite strictly when you get to retirement. So a lot of investors tend to forget this part, that you now need to start earning an income between 2.5% and 17.5%. And you can only change this once a year. So if you have crisis, we can't do anything for you. So having an accessible portfolio, which is also taxed in a different way. So that would be taxed, it could potentially be taxed in a much friendlier way. So how a voluntary investment or a flexible investment, or all the platforms have a different name for it, but anything that is interest bearing, so basically cash and bonds, would be you have certain exemptions that you can qualify for every year, and then it's seen as an income tax earning above that. Everything that's in equity exposure can possibly trigger capital gains tax, but it's not that your income out of this investment is taxed at an income tax level. So you can very much manage your tax implication on this structure. So I think if you optimize all of the products together, keeping your income earning out of the living annuity or life annuity as low as possible, and basically supplementing from a tax-free investment and a voluntary investment, you can really manage your tax implication and keep it quite low.
Aubrey wants to know, how much do I need to contribute to my pension fund each month in order to retire comfortably in 25 years? So, I mean, I guess the first assumption there is your retirement age is 65, which off the 25 years means that you're currently at 40 years old. You've got another 25 years to contribute towards that. How much realistically, if you've only got 25 years to start contributing and you have to contribute monthly, is there a calculation one can do? Is it based on your income? Is it based on how much you're saving per month? But I guess to Aubrey's question is, how much should you be saving so that at 65 you're not too stressed out about the situation?
Yeah. So this is where the calculation and the individual calculation comes in. I don't think there's a set rule for any individual out there, but there's a few components that make up the calculation. So firstly, it's a percentage of what you're earning. So we want to try to replace what you used to, if you want to keep the same standard of living. Of course, whatever has been saved up until now, if there is anything to work with. And then the investment strategy becomes very important. So if you're going to be earning a 7% return compared to a 10% return, of course, the outcome is going to be very different. So I think taking all of these inputs into calculation, and as from there, every year can make a difference. If you retire 1 year earlier or 3 years later, it can also look different. But basically, it comes down to a percentage of what you're earning. And that can be anything from 10% to 40%, depending on what you've done and what your expectation is at retirement. Will you be okay with less than you're earning at the moment, if you maybe have a replacement ratio of 80%? Or do you actually need to be able to replace your entire income that you used to now? But it's something that can be calculated,
So then, where do we start? So let's take Jimmy as an example, 30-something-year-old male, hasn't started saving for retirement, wants to now look at that, has 30 to 35 years of starting to save and that sort of thing, just got a new job. Where do you then begin so that you optimize the time you have left? Because what you mentioned earlier around the fact that the sooner someone starts, the better it is. So if I'm at 30 years old and I didn't start at 25, I've already lost 5 years that I could have earned the compound interest and been diversified in various portfolios and that sort of thing. But let's say I'm at that point now where I'm ready to start. I finally got income and I can save some, and this is what I'm looking to do. Where's the starting point for me?
I would definitely recommend starting with your retirement fund, so to start optimizing these tax benefits from the start. And I think that's a very much underutilized benefit in principle in any portfolio. So if I can maybe just fast forward it a bit, but if you can start building up your contributions to a retirement fund within your working lifetime. So basically the main tax benefit is you can deduct on an annual basis 27.5% of your taxable income, up to a maximum of 350,000 rands a year. And this is now an annual benefit you get. But anything you save over and above this benefit starts getting pulled up in a disallowed contribution pool, which you can one day again offset against your income and pay less tax. So there's amazing tax benefits that you can start implementing for later on in your life and essentially create an almost tax-free retirement if you start doing it early on. So optimizing all your tax benefits from the start, I would do a combination of two things. So starting to save in your retirement fund, but also starting to save in a more accessible investment for more than one reason. But I think having that emergency fund, which we all need at some point, but also in terms of investment strategy. So retirement funds are governed in a different way. So you can invest accessible investment in a completely different scenario and diversify in that way as well. And then I think in terms of contribution, calculate from day one what is more or less needed over a 30-year period if you start saving 15% of your income, for example, and every year increasing that with inflation at least perhaps or perhaps more. And that calculation needs to be revisited often because, of course, everything can change. Your income is changing, market returns are changing. So at least ensuring your portfolio planning is staying on track. But I would make sure I make the right decisions from day one. You're going to, in terms of investment strategy and in terms of contribution and costing and all of that, so that you're not losing too much time.
For those of you just joining us, I'm chatting to Elke Brink, who's a director at PSG Route 21, about the ability to retire on 2 million Rand, whether it's feasible, whether it isn't, and what it is you need to do to retire comfortably. Please note that all our sessions for today will be available on the Moneyweb YouTube channel as well as on moneyweb.co.za this week. So if you miss any of the sessions, don't feel bad. Download the Moneyweb app. You'll still have access to all of the sessions. You'll be able to watch them back. But Elke, back to you. I mean, I just wanted to look at the retirement side of it from, we're at 65. Yeah. I've retired. What do I then need to do? Because you mentioned that keeping the funds as cash or being conservative at that point might not be the best option. So what do I need to do at the point of retirement? Let's say I've amassed 3 million, 5 million, the amount isn't really relevant, but what do I do to ensure that the money keeps growing, even though I'm going to be drawing on that money almost on a monthly basis? Is it advisable to draw on a monthly basis, or should I do a quarterly withdrawal in bigger lump sums and then just manage my budget better over that period?
Out of a market timing perspective, I would definitely say stick with a monthly drawing. Because of the reality that you can't time the market. So anything can happen at any point. Should it be a pandemic or a war or a banking crisis or name it, there's always going to be something new. So I think in terms of that, try to basically even it out on a monthly basis and start building up your budget planning in terms of that. Together with that, the investment strategy becomes incredibly important at this phase in life. And that would depend on what your income need is. So how much do you allocate to more conservative asset classes and what do you allocate to growth assets or equity exposure, combination of local and offshore, of course. But I think that's one of the biggest mistakes that a lot of investors make at this point in time, that they feel now that I'm retiring, I need to be invested more conservatively, where that's not really the reality. The investment term that you're working with is actually very long still. So even if you're 65 today, we may be entering a new phase of another 30-year investment term. So in terms of the equity exposure and the time frame you have around that, we have a long time to work with still. So be wary of going too conservatively and ensure that the strategy is accommodating your not only over and above inflation, but your income need as well. And then optimizing your tax-free components. So normally at retirement, that was now increased with the last budget speech, you can access up to 550,000 Rand tax-free, which my recommendation would normally be to take it out and reinvest it in an accessible investment, where this can either supplement your monthly income or it can be used as an emergency fund, depending on what your need is. And then together with that, the remainder of the funds will now have to be invested in either a living or a life annuity or a combination. I personally recommend a living annuity. I just think there's much more flexibility in terms of the product for many different reasons. You just keep your options open in terms of investment strategy, income drawing, all of this going forward. But mainly you will need to choose an income between 2.5% and 17.5%, and this can only be revisited once a year. So that needs to be planned very well. And there's a certain recommendation here where we would normally say 5%, depending on the strategy, of course. It doesn't help you draw 5%, but you're only earning a 7% return. So the strategy becomes incredibly important together with your income drawing.
So I'm getting a sense that a lot of it comes from going to the end and saying, how much am I going to need at that point?
Yes.
And working backwards from that to say, okay, if I want to have 30,000 Rand a month in retirement, after tax, because that's something we all have to consider, how much do I then need to, and sort of calculating backwards to say, to get to that 30,000, for example, I need to be putting aside 2,500 a month over this particular period and that sort of thing. So the products and the strategy and all of that comes into play once you've determined sort of where you're going to be at that point, right?
Exactly. I think it's so important to determine the end in mind. I think it can be seen as a marathon or running a long distance race. It's not something you just go and do. You need to plan with the end in mind, and then we can work backwards from there. And I think it's important to have a plan. It's much easier if you know more or less what type of lifestyle you want one day, where are you heading, at what age do you want to retire, do you want to travel then, or do you want whatever you want to do, but then it's easy to plan. And then you're going to know if you're still on track or not leading up to it. Otherwise, you're just basically running into this blind and not knowing where you're going.
So then where do investment managers fit in? And I think the reason I ask this is because, one, we don't know how, life is unpredictable. We don't know what tomorrow holds, right? So the plan is, yes, plan for the eventuality that you do live to 100. Yeah. But from an investment manager's point of view, I mean, how do we get investment managers to then align goals or set goals for clients so that it's a situation where, one, it's more fashionable and more proactive on my part as an investor to want to be involved in these sorts of retirement products and to want to have retirement front of mind, because often we don't do that. Often we find ourselves in situations where life takes control on a daily basis and we say, okay, cool, to that extent I'm going to live for the now because I don't plan on living 35 years beyond my retirement age of 65. So what's the role of investment managers in that space to then ensure that these things stay front of mind and you stay focused on remembering that you are going to retire one of these days?
I think unfortunately we live very much in an instant gratification generation where I think it comes down to discipline in a big way. I think there needs to be this independent, and I think that helps working with an investment manager because it takes the emotion out of it and it keeps a goal in mind. So really ensuring as your life changes, with every individual's life changes significantly on an annual basis. So knowing that you're still staying aligned with your goals, and I think that's where a lot of the short-term planning comes in as well. Should unexpected events happen, at least you know you're not touching the long-term planning. So just ensuring that's staying in place and that you're actually making active changes as your life evolves, because I think that unfortunately happens a lot that you don't revisit your plan. So now you're not actually keeping up with the goal or the plan. And then together with that, as with any relationship, I think the communication is very important between the manager and the individual. So knowing what the goals are, and if they do change or if unforeseen circumstances come, or positive things, you want to go on a certain holiday or you want to buy a home or whatever it may be, that you plan your portfolio accordingly. So it's much easier from a managerial point of view if you actually know what the goals are that you work with to know how to plan for them. So I think really actively working with an individual, not just once a year, but actually on an ongoing basis and planning for everything short-term and long-term.
Thank you, Elke. So plan for the retirement that you want so that you're not stuck with the retirement that you can't do anything with. That was Elke Brink, who is a director at PSG Route 21, just running us through what it takes to retire. Can you retire on 2 million Rand? How much planning goes into ensuring that you can retire comfortably? And she's left us with this closing bit of advice that make sure that your financial advisor or your financial planning team is a team that understands your goals and will assist you in achieving those goals. And to that end, stay tuned for our final session of the day where we look at the financial advisor side of things. We look at how to pick a financial advisor, what the right financial advisor looks like, and what a good financial advisor can actually do for your portfolio. Stay tuned.